In this video, you will learn the top 5 best and most consistent indicators for Bitcoin and crypto trading to completely dominate the charts. Directly after this video, you will have a significant advantage over all other traders and will make more money in trading. Alright guys, welcome to a new video. If you're new here, make sure you subscribe, hit the ring bell so you don't miss any important tutorials or urgent update videos. As always, I have my black tea today and also have my fennel tea. That's also why you should get a drink. Leave a like for the algorithm and let's start right away. Number 1, the triple EMA. Now EMA just simply stands for exponential moving average. On the chart you can see right now, I have 3 of them. I have the 21, which is the fast one. I have the 50, which is a bit slower, and I have the 200. Why those 3? Because they are the most consistent and respected EMAs in trading. As you can see here, I have 3 indicators, but there's actually one which combines all 3 into one indicator, which means you save space here and you can save money because you don't have to upgrade and buy the pro version, which is what I have. So just simply go to indicators, then type in triple EMA, and you will see this one here from Will charts, like this one here. Click on this one right here, and then we will do some customization. So click on the settings tool right here. I have 21, I have 50, and I have 200. For the style, I have this one in neon yellow. Just click on the plus sign. The color code is E2FF00. Then again, I have the 4th gray right here, and I have the basic orange, and I have the 2nd thickness. You can just copy my style, or you can just take your own style. This is just what I'm used to, so that's why I use these colors. The 3 EMAs have 2 purposes. The first purpose is they are dynamic support and resistance in the uptrend and downtrend. When the EMAs are opened up to the upside and the 21 is on top, 50 is below, and the orange one below, that's when you are in a strong uptrend, and that's when the 21 and 50 are dynamic support. Same thing in a downtrend, they are resistance. So for example, we can see here 21 is below, 50 is above, 200 is on top. They are all spread open, which means strong downtrend. And you can see every single time when we get to the 21 EMA or the 50, this is a pullback area where most likely in a strong trend, the price will pull back to and continue, as you can see right here. And there are actually 4 setups that you can trade to use to your advantage with the EMAs. The most consistent and best setup is the advancing wicks pattern on the 21 or the 50. The win rate is around 80%, and you can watch the video also right here, which actually is the most #1 watched video on my German channel actually, and for a good reason, because it's the most consistent pattern that you can trade on the 21 and 50 EMA. Now the second pattern actually is a new scalping strategy, which is actually a failed bounce, because most beginner traders, they will actually go long on the 21 and on the 50 in the uptrend, and they will go short in a downtrend on the 21 and 50. But actually many times, and there are specific rules that you can follow, they will actually fail. And that's exactly why I will most likely also make a new YouTube video very soon about this new setup. So far the win rate has been around also 70 to 80%. For now, the only place where I exposed this strategy is only on Discord. Actually, I made multiple live streams on Discord between 4 to 6 hours where I cover dozens, even hundreds of examples. And you can clearly see that the win rate is around 70 to 80%. I will put the Discord link for you in the description. You can join right here for free. And also I will put it in the pinned comment. Just click on read more and then you can join right here on Discord. Once you're on Discord, all you have to do is just simply go to the Get Verified channel, then make an account on BitGet with this link or on CoinCatch with this link. Then you have the lowest trading fees on both platforms and the best trading conditions in the world. If you are in the UK, US, Canada, or Singapore, you have to use CoinCatch, which is the non-KYC version of BitGet. Technically speaking, you are a little bit more profitable because you save a little bit more on fees. However, BitGet is the bigger platform and you have more features. But if you just want to trade and scalp, CoinCatch is actually numbers-wise the better option. Now, once you made your account, just select BitGet or CoinCatch and then simply put in your user ID right here. Once you click submit, then you will be accepted most likely in 1 day. And then you can see all these channels and then you can go to announcements. And this is where I posted all the live streams where you can see all the new setups and also all the examples. Also, you can do the free 7-day bootcamp right here also. All the recordings are here. You can do it at your own pace, depending if you learn fast or slow. You can do it fast or slow. And then we have also an exclusive resource channel and also many other things all for Discord. And there are 2 side setups, which for now are only in the live streams in Discord, but I think I will also make dedicated videos in the future, so stay tuned. The second purpose of those 3 EMAs is actually for orientation and to filter out bad areas for your trades. Because for example, when all EMAs are very close to each other, like for example right now in this section here, this is a very bad area to trade, and most likely the price has very arbitrary price moves. Just simply avoid trading. These are the no trade zones. The best times to trade are either when all EMAs are opened up like this, because then you have a strong trend and you have mostly clean price action, or again, if they are to the downside opened like this, once again, they start crossing up like this, and it gets very, very close like this, I would avoid a little bit until again they open up like this. This is an amazing filter, and by doing this, you will actually avoid the bad areas where you have more than normal losses, and you will not miss out on many wins, which means it's a net positive for your win rate. Indicator number 2, and this also is one of my favorites, which is the RSI, which actually stands for the Relative Strength Index. For this one, just go to indicators, type in RSI, and select this one right here. Now, this is a very, very famous indicator, and most people completely use it incorrectly. I will make a very dedicated video about this indicator. The best way to use this indicator is to spot divergences. A divergence is simply a discrepancy between what the price is doing and what the RSI is doing. And these are most of the time a 60-40 your favor trade setups. Now, there are 3 main types of divergences: regular, hidden, and also a third type, which most people actually don't know, and that's why also I make a dedicated video about the third type. A regular divergence is a trend reversal pattern, and a hidden divergence is a trend continuation pattern. In the uptrend, you just simply look at the highs of the price and you look at the highs of the RSI. Here, for example, we can see while the price makes a higher high, the RSI actually made a lower high. We have a bearish candle right here. In fact, we have a 3-line strike pattern here. What happens? Price goes down. From a technical perspective, this means that the momentum on the second high is much, much less, which means it's weaker, which means it's more likely to actually go down than up. This right here is a 60-40 setup. However, if you have sharp eyes, you will tell me, wait a moment, Claudius, here we have a higher high, and here we have a lower high. But what happens? Price still goes up. Also, wait a moment, here's a higher high, but here's even a lower high, but the price goes up still. Correct, because the swing between the two highs are like a very steep Nike check. We have a high, a higher high, like a Nike check mark. Same as here, but here it's more like a bowl, more round. Because in fact, if you have two highs and they are like this, like a Nike check mark, it's around 50-50. If it's like a U shape, it's 60-40. So 60% chance down, 40% chance up. If between the two highs you have a longer sideways consolidation area, this means that the chance actually is only 55-45. And also, if the price is going up very slowly with many counter candles on the second way up, this also only gives you a 55-45 chance. So ideally, the price comes up, you come down, no pause, you come up, higher high, 60% chance going down, 40% chance going up. Now, there are also 2 more filters that you can use to actually increase or decrease your chances and therefore avoid the bad setups. Number 1, if on the second high you have no top wick, this also reduces your probability by 3%, which means you want to have a top wick on the bearish rejection candle. And also, if the RSI is far away from the SMA, also, this also reduces your chance by 3%. If the RSI is very close to the SMA, or you have a cross, this also increases by 3%. Now, for this, actually, you can do an improvement on the RSI. Just go to settings right here, and you have to edit on inputs the MA setting to 8. 9 is also very good, but 8 is a little bit better. That's why I use 8. But 9 is also decent. But again, 8 is better. Here is the opposite example. In a downtrend for a regular divergence, you always check the bottoms on the price and you check the bottoms of the RSI. Again, in the uptrend, you look for the highs on the price and the highs on the RSI. So again, let's go back to here. We have a lower low on the price, but the RSI makes a higher low. So this here would be a 60-40 setup, 60% chance of going up, 40% chance of going down. However, because right here we have somewhat of a Nike shape, not very steep, but somewhat steep, this makes it only about 55-45 in this scenario. Also, we can see right here, we have no bottom wick, which again is minus 2% chance. The RSI actually is quite close to the SMA, which means again, it's a plus 3% chance. So this condition on the RSI and no bottom wick condition, they are canceling each other out. And then again, because it's a Nike shape, but not very steep as in the bullish example, it's around 55-45. If it was more round like this, it would be 60-40. And if it was even steeper, then it would be only a 50-50. So again, those are the filters, and you can also test this yourself hundreds and thousands of times on the chart, and you will see that this is playing out over and over exactly according to those probabilities. Now let's cover the hidden divergence. The hidden divergence is a trend continuation pattern. So in the uptrend, you just simply check the lows of the price and you check the lows of the RSI. So here, for example, while the price makes a clearly higher low, the RSI makes a clearly lower low. which means what? Which means in the uptrend, the momentum overextended the downside, and most of the time, in a strong trend, when all the EMAs are opened, the chance is 60-40 that when you have this, that actually will continue to go up at least a little bit more or even a lot more. Now that's why this is also a very good setup, and you can combine this actually also with other price action. For example, a hammer candle, or even better, advancing wicks, Morningstar, 3-line strike. If the RSI is far away from the SMA, from the 8 SMA or 9 SMA, whatever you choose, this also reduces your chance, -2%, that it will not work out. If they are very close or you have a cross already, again, +2%. Here we have a bottom wick, which means +2%. If this candle here had no bottom wick, again, -3%. Now here, for example, we also have the confluence of a 21 bounce. So here we have essentially two reasons why the price actually might go up again, which again would give this around a 60-40 chance of going up. And in this case, it did also. In the downtrend, it's the exact opposite. You simply check for the highs of the price. So for example, the price here makes a lower high, but the RSI makes a higher high. Now what does this mean? This simply means that in a downtrend, the up momentum overextended, and most of the time when the EMAs are open like this, it's again a 60-40 setup. Same rules apply if you have no top wick, -3%. If the RSI is far from the 8 SMA, -2%. In this case, for example, it is actually quite far away, as you can see here. That's why here, -2%. But we have a nice top wick rejection, which means again, +3%. Also, one important thing to consider. Here we can see that after the rejection candle, we have a very nice risk reward because the rejection candle is actually very small. So if you enter a trade here, you would enter after this candle closes, your stop loss above the highest wick, and you will target the lows or the same low. Most of the time actually you can target a bit lower. Why? Because if you have a sweep, mostly it will exceed by quite a bit. That's where you can choose, for example, this target, and it will give you a 3.7 risk reward, which means you would make 3.7 times the amount that you risk on this trade. So in this scenario, this would be a 60-40 setup, which is actually very good, but the risk reward makes it even better. If this bearish candle was a lot bigger, so for example, it closed all the way down here, then it's not a good setup, because then the risk reward here will be only a 1.26, which is actually very bad. As long as the risk reward is at least a 1 to 2, it is a favorable trade to take. I would rather take a little bit dodgy setup with a very good risk reward than a clean setup where everything ticks with only a 1 to 1.5. In summary, a regular divergence is a trend reversal pattern. In the uptrend, you look at the highs, higher high on the price and lower high on the RSI. In the downtrend, you check for the lows of the price and the lows of the RSI. For hidden, it's exactly the opposite, and that's a trend continuation pattern. You check for the lows of the price and the lows of the RSI in the uptrend, and in the downtrend, it's the opposite. You check for the highs on the price and the highs of the RSI. Indicator number 3. And now it's getting very spicy because this is one of the most overhyped indicators on entire YouTube. If you type in smart money concepts on YouTube, fair value gaps are one of the most mentioned things. And let me actually first of all show you how to use it. So let's go to indicators, then type in FVG, and just use this one here from Spaceman BTC with the EP tag. Click on this one right here, and there's also one important thing. Go to the settings right here and make sure that you match this here with the time frame that you trade on. I'm right now on Pepe on the 1 minute chart, so make sure you select here also the 1 minute time frame. You can either make the indicator delete the old ones once they are filled, or you can make it like this so they stay actually on the chart forever, which I would not recommend because it's just confusing and it's not practical. But first of all, let me explain for everyone who's new here what a fair value gap is. A fair value gap is just simply a price imbalance. And to make it easy for your eyes, just simply look for big candles on the chart which stand out a lot. So for example, this is a big bearish candle, and then just simply look at the candle wick before and the candle wick after, which reach into the candle. So for example, between this wick right here and this wick right here, this is a fair value gap. Most beginner traders actually use these as trade entries. However, the market loves to fill them over and over and over like there is no tomorrow. That's why actually to use them as a trade entry is very inconsistent and very risky, because most of the time the market will chase them, fill them, and actually invert them. On this bullish candle, we have another fair value gap. Check the candle before. This is the top wick. This here is the bottom. And then here, candle after, this is the wick. Now this here, from here to here, is the fair value gap. And we can see right here, we got filled. And actually, as you can see, this candle closed past the fair value gap. Now this candle essentially inverted the fair value gap. Now this would be now an inversion fair value gap, which is also, by the way, a good setup. It's also around a 60-40 setup. I sometimes trade it. If you want, I will also make a dedicated video about inversion fair value gaps, which still is a decent setup. Now again, here we can see we bounced a bit and we came down. That's why actually I don't use them as trade entries. I use them as take profit targets or as partial take profit targets. Like I said, market makers love to fill these imbalances over and over, and that's why they are like magnets where the price will come to and exceed. So for example, how would you use it? If you, for example, had a long trade entry right here, somewhere in this area, then you would look for big fair value gaps in the market. So for example, from here to here is a big fair value gap. And also, by the way, let's go in by replay mode. So you can see actually that the indicator would show you that this is a fair value gap. But now, of course, it didn't show it because we filled it after. So let's say anywhere right here in this bottom, you have a long setup, which you don't have right now, but let's say you have, then you could target this big fair value gap as a take profit target. And by the way, most people will have here a short order, and you know market makers will most likely actually stop them out rather than actually going down. So for example, this is the Pepe chart in the present, and we can still see there's a big fair value gap which has not been filled, which means if you have any nice long entry right here, for example, in this area, this will be a very nice target as you take profit or as a partial profit target that you can hold out for, because you know this is a big magnet and lots of liquidity and unfilled orders are laying there, and that's why the price will always chase it and most likely fill them. Indicator number 4, VRVP, the visible range volume profile. It sounds complicated. Actually, it's very simple. So just simply go to indicators, type in VRVP, and just take this one here, visible range volume profile. So click on it. I already have it here in my list, so I'm gonna make it visible now. And this indicator only serves two purposes. So step 1, zoom out to the range where you're right now trading, and then you can see here we have a red line. Now this here is the highest volume traded area of that entire section. This is the point of control, and this also serves as support and resistance and as extra confluence for your trade entry. So for example, let's say that you are here, and let's say that in this area you have a long setup, but also at the same time you have the point of control here. This gives you an extra 5% chance your favor, because actually this is a very strong support in the uptrend and downtrend. On the same side, if you drop below the point of control and you come up again to this volume bar here where the red line is, this again is an extra confluence to go short, which again slightly increases your chances of it going down. That's purpose number 1. Purpose number 2 are minus distributions. This also again sounds complicated, but it's actually so simple. A minus distribution is just simply a big volume gap. So for example, you can clearly see that from this point onward to all the way here, there's almost no volume traded. This is a big volume imbalance, and this is a minus distribution. And the purpose of this is actually that you know that if the price breaks below this, the price can easily fall below, because this shows you that from here to here, there's not much buying or selling interest, which means if people sell down or if people buy up, the price can move up and down very quickly. So let's say you're in a short position because you saw that we made actually a higher high on the price, but the RSI made a way lower high. And also, we have a very nice U shape. Now, because you know this indicator, you know that right here is a massive minus distribution, and you know that here are big fair value gaps which are not filled yet. So you know that this area is a massive magnet because of all the fair value gaps, and you know that the price can fall easily through here because we have a minus distribution, which means not much volume interest in this area. While everyone who don't know about this indicator will just target the 200 EMA right here, you can actually target lower because you know that this here is an area where the price can just fall through very easily, and you have all those fair value gaps. That's why you can target lower, for example, right here, and also even right here, because here we still have a big imbalance on the volume. So now let's play the candles and see what happens. And we actually come down, fill all this imbalance and the fair value gaps, and then again we go up. You only know this if you have this indicator, and you can actually see where those gaps are and also where the point of control is. Indicator number 5. Now this also is really helpful. It's the Hawkeye volume. Just type in HAWK and just select this one right here from NADA86, and I also have it here in my favorite list. Click on it, and this only has one purpose. Before you trade any asset, just simply zoom out a little bit and just check where is the volume right now in comparison to where the volume has been in the last recent times. If you can see that the volume right now is high, either higher than the average or the same as the average, then you can trade. But if you can see, for example, that right now the volume is way lower compared to the recent times, then I would simply avoid trading. Why? Because if the volume is low, you have mostly choppy price action, unclean price action, and also low liquidity. And most of the time when the volume is very low, the percent moves on the asset is also very, very bad. That's why simply avoid trading when the volume is very low. There's one more bonus indicator, which is the Bitcoin top and bottom signal indicator. For this, you can also watch this video right here. I really hope that you learned a lot from this YouTube video. If you have any questions, please comment down below. I will read your comments and answer all questions. Please leave me your feedback down below and I will help you out with all my heart. Next, you can watch this video or this video. Thank you so much for your insane support. Much love and peace. I will see you in the next video and ciao.